topics that may be new to others. Um, and my hope is to encourage you all to be ambassadors of the necessity and the benefits of having a life insurance strategy in place. Let me see if I can. Am I advancing it? Yes, it works. Okay, so let's talk life insurance. Again, I am a life insurance broker with a company called the Wealthway. I'm a realtor under a company called Maximum One that's throughout Atlanta. But before we get started, I'd like to start with a couple of historical fun facts, if you will, about the history of life insurance. The earliest recorded text that they found, based on my research, came in 1750. Was the in Babylonian Empire. Was It dealt with loss limitation methods. Basically, merchants would basically insure their property as it was sent places. It was invaders, all kind of things. Because what we'll hear a lot about today, I mean, in media, Lords of London and England, where it all started. No. Babylonia, Africa, insurance as well started there first. Marine insurance became really important and popular because of the triangular trade routes between Africa, Europe, and North America. So marine insurance became kind of popular in the 13th century and actually extends to this day. In America, the Friendly Society was established in Charleston, South Carolina in 1735. And yes, they insured captives, pretty much. They insured captives as property, and those captives were enslaved here in the United States. The official recognition for life insurance in the United States started with the company in Philadelphia, where actually a ministerial, the Congregation of Presbyterian Ministers Fund was a fund that was set up for the widows and children of the families of priests who had passed on. So that's the official life insurance story. But we all know that 1735, if you're insuring the lives of people with heartbeats, that is life insurance in 1735. I have to let people know that as part of our culture. Just want people to know the truth. Now, African Americans and LIMRA. LIMRA is the Life Insurance Marketing and Research Association. It's a trade group. And they have a data exchange, and they provide insurance companies information and statistics on people. And I like to share some about ourselves that have been collected over the years. And just so you know, most insurance companies in the world are a part of LIMRA. Now, right now, African Americans, we own 56% of us own policies. I was not able to segregate between which one of those, whether these are portable versus non-portable policies. And what I mean by that, the policies that I sell are portable. They go with you wherever you're working. You got policies at work. They're great to have, but we encourage portable policies because we don't know where we're going to be down the line. And most people pass away after retirement. So having an insurance policy at work is great for the now, but we plan to live long lives. We need to get something that can be priced before we turn age 65. But there are options available. African Americans have 33% less coverage than the majority of America, and 46% of us need more coverage. I could always use more. I'm sure my kids would agree. Now, what we do notice here is that 71% of African Americans had insurance in '89. It went down to 61% in 2013, and we're now at 56% as of last year. Now, this could be the case of just declining benefits at some jobs. If I'm not mistaken, you may find a job like Walmart may have had full benefits in '89, whereas now most of the employees barely have health insurance. So that can be impacted that number greatly for all Americans, to be honest. 75% of African Americans overestimate the cost of life insurance, whether we are 18 or whether we are 55. You only know till you know. It can be pricey depending on where you are with your discretionary spending, but you have to find out from a trusted professional. Now, 30% of African Americans, it is said that they are looking for a trusted professional to help them with their needs. I assure you, you can trust me. If you have questions, or if you have any questions, just let me know. Now, life insurance benefits. Number one thing we want to do is protect the goals and dreams of our family. We all get up, you have kids, or you have nephews or wife, there's people in your life. You may love your school that you graduated from. And you want to protect those ideas you have. Oh, one day I'm going to, send $100,000 to Mother Tuskegee. Oh, that would be great. Well, we put these policies in place, life insurance policies, to protect these goals, these dreams that people have, just in case the unexpected happens. Another thing that's done with life insurance is to transfer or create wealth. And I was telling Brother Baloo, I understand the word generational wealth, and I wanted the proper word to use with you, Brother Baloo. There's also transitional wealth. Like most of my clients were just like me. The life insurance that my mother left for me and my brother, it transitioned me, out of a certain amount of debt that really impacts me some 23 years after she's passed away. So you have, it may send somebody to college who didn't have money to go. It may dig somebody out of a hole. So it's not necessarily always generational wealth, because generational wealth has become like a buzzword that people run from sometimes. But, if you talk about transitioning from one level of the economy to another level, that's really possible, whether it's for kids or for even adults, to just create a different situation for yourself or for someone else. This for the uber rich, and for everyday Americans in certain type of policies, there's an ability to grow money inside of a life insurance policy. I would say similar to the way you do it in a 401k, except that is an investment account. These are mostly more in line with savings accounts. But as the money grows, the money can be taken out, used while living or afterwards. Money is transferred without a tax burden if it's done the appropriate way. We'll talk a little bit about that a little later. Living benefits. This is why I got into business. When my mother got multiple sclerosis in 1981, passed away in 2000, in 96, things got rough economically. Yes, she had a MetLife policy. It was a whole life policy, and it was what it was. It was an amount, and she made a payment. If she would have had the long-term benefits, especially the chronic care benefits, she would have been able to do things like, take money that was going to be received after death to handle bills today, to handle situations today. That is the great thing about life insurance today. Living benefits, and not just in a cash value policy, but even in the term policies, which we'll talk about later, which are budget friendly, but you still have the same opportunity to help yourself. So you have living benefits that deal with long-term care for those that are maybe over 60, or even, unfortunately, some people have to use it after 40 because things come up. Critical care deals with if you have an accident, stroke, heart attack, these type of things, just to get back on your feet. Chronic care is for things where you get a serious diagnosis like my mother had that you may not recover from, or you may have to take time off from work to go off and fight something. And it's really sad to see a person have to literally fight for their lives for 4 months just to return to regular life, to reality, with a smile on their face, and have to file bankruptcy. That's not fun either. Build retirement income. I'll say this, start early. It's just like your 401k. It told you, if you only put $80 a day in at age 18, you have start early. Early, you can use, as I said, you can use a life insurance policy to complement or supplement your 401k pension or what have you, wherever you are. But it takes time to build these things up, and they can be utilized later as the money is taken out of a policy in a proper way, and it can be taken out without incurring a tax liability. Now, what makes us eligible for life insurance, and how do they determine our premiums? I'll say it once, I'll say it all night long. If you love somebody, if you have an 18-year-old in your life, don't buy them another Christmas gift. Take them down and get some type of coverage. Talk to me about it. Talk to somebody else about it. Age is a critical factor. Gender, females pay less for life insurance premiums, than men. And if you stay on YouTube long enough, you know why. Because men, sometimes we choose. Well, some men choose to do the tough things in life. A lot of men choose to do the foolish things in life. So that runs our rates up, as some of those foolish things and the courageous things don't work out always. Now, they can call the industry sexist. I didn't set the rules. I'm just here to explain how it goes. But feel free to pay more if you like, ladies. Health status and history. This is, again, why I say, get somebody started at age 18, because the problems I have now, I didn't even think I would have them between the ages of 17 all the way up to about 25. I was untouchable. But I've been touched, and things change once these touches come along. So, like I said, early and often. And then sometimes you have a situation where a person may have been, I have had clients, they are 40 years old, they forgot that they were hospitalized for 3 days when they were 37. So they do look in your history like, oh yeah, that's the time when I had XYZ, and I forgot all about that. So, and what the insurance companies want to do is just insure something that's not long lasting, that's permanent, maybe it was resolved, but the underwriting process can be pretty extensive. If most people here probably have purchased a home, and you go into underwriting, it lasts for about 15 days to underwrite a home less than $250,000, maybe up to $400,000. Takes about 15 days. Well, that house is less likely to experience a terminal end. So when it comes to your life, for a $250,000 policy, it can take 30 days for them to run through so many things just to make sure that they want to take the risk or calculate the risk correctly for your life. Family medical history. I'm going to interject this right now. When I or a life insurance agent, salesperson, whatever, ask you a question about your family medical history, only answer the question that was asked. You start talking about 25 cousins that had this, and usually we will ask about parents. No need to tell us about grandparents and great grandparents. I'm glad you know them, but we don't want to add that to the application. The underwriters that sit in very dark, wet, damp rooms tied to a desk, they're very jumpy people. So you don't want them to start pulling up death certificates on people that are not supposed to be on your application. Occupation. Do you sell houses and insurance? Or are you in the military? Are you an over-the-road truck driver? Where you're out on the road 21 days out of the year? You work in the oil fields? Or do you work in Walmart selling oil? It all matters, because some jobs are inherently more risky than others. Nothing impacts you more than your age, other than smoking. And that should go into health status. I have a nephew, and this is the last time I've done this. I ran his insurance policy, came out to be $40. He said, oh, he smokes. It doubled. In most cases, that premium is going to double. If it doesn't double, it's going to increase by 95%, if not 110%. So, if you can get rid of nicotine before you get your policy, that'll be great. Lifestyle. Do you fish on the banks or by a pond, or do you get out on a go out and get the deadliest catch? Are you a skydiver, parasailer, that type of thing? I will introduce this too because it is kind of popular in our community. Whether you're getting a crotch rocket or you're getting a cruiser, if you don't have life insurance and you're thinking about getting a motorcycle, please get your life insurance policy set first. It's not as bad as smoking, but almost 50, 70%. They don't even care about what you're riding. They just want to know if you ride. So that type of lifestyle decision can be costly. Credit score on the companies that I write for, which as a broker, I reach out to maybe 50 companies, but I really have only written policies for maybe 6 of them. Nationwide, Pacific Life, Transamerica, some people you're very familiar with. They don't ask for permission to pull your credit score, but in Georgia and Alabama, they can. 7 states have found no reason for them to run your credit score because people think checking credit scores it adversely impacts other groups more than others. And they're like, what does it have to do with living? Some of the people in the insurance industry may say, well, if you won't pay your bills, you're always behind, you're always scraping and scratching, maybe you don't take care of your life as well. And when they say the credit score can impact you, they're not talking about a 580 or 560. They're talking about something below 520. I don't even know how low credit scores go, but I know you can get into the 400 and you have to be in a really bad situation to get there. But like I said, for the majority of policies I've written, they make you sign disclosures and permissions for a lot of things. I have not come across the credit score on that part of the application, but they are always changing applications and it changes every day. Okay. Key question: what is the best life insurance policy? And the truth of the matter is the policy that best fits your situation. That's why when you meet with me, we're going to have at least 2 meetings. I have to do a fact-finding meeting, not just your age, ask you about your weight, your health, and all these things. But what do you want? What do you want to protect? Who do you care about? Why are we doing life insurance? Do you just, even though you're 30, do you just want to have final expenses taken care of? Or are you 50 with no children and you have 12 nieces and you want to make sure that you leave something behind for them? A lot of times people sell your life insurance policy in one phone call. It can be done, but I know we're supposed to show care. We're supposed to do our due diligence to make sure we put you in the best situation. Just because you can pay for a $2 million policy doesn't mean I should sell you one. I would love to do it, but as a professional, I'm supposed to make sure you need $2 million of coverage. It could be 1.3. Either way, I would still be happy. But I want to do my due diligence. My paperwork with my organization needs to line up and say, hey, we talked about this situation and this is what's needed. And this is what was approved by my client. You're all probably familiar with term life. It's budget friendly. You can get adjustable terms, 5 to 40 years in some cases, depending on what your age is. Once you get past 55, they may not give you more than 20 years of coverage for the term. To explain term best, it's kind of like renting an apartment. You're renting life insurance coverage for a period. It's real friendly, but there's some great things that can happen. I'll tell you about in a second. You do have the living benefits with term policies these days. That's a new thing that's been added, I think, over the last 10 years or so, maybe even 15, but at least 10 years. And riders. Riders are add-ons. Cost you a little extra money, but say you want to have $10,000 for your children. That's a common rider, costs you a little bit extra. The most expensive rider is like a disability or an unemployment rider. And what that does, if a disability happens, or if you become unemployed for a certain amount of time, the company will keep paying the policy because you cannot, because of disability or unemployment. That runs the price up of a term policy, but most people select not to get them because the term policies are so inexpensive, but they can really be, it's good to have just in case something comes up. Term policies can be sold as a straight term policy, meaning I give you a premium, you pay that premium until the end of the term. And then there are some policies called return of premium. A return of premium is exactly what it states. If you pay $50 for every month for 30 years, at the end of your term, they will give you a check for every dime you've paid. Once you get into the whole concept of present value of money, you know, $1 today is worth more than $1 tomorrow. It's not the greatest of ideas. It's just an idea. Now, somebody that may use a return of premium is if we have a business arrangement, two business owners, or two business partners, excuse me, they may get policies on each other. $2 million return of premium. Just in case they're 40, they're starting out, business grows, the policies do one thing. If client, if partner A dies, it pays, the policy will basically pay out the other side. Like, you know, it's just, it's a great policy to have, like for partners. They just can, basically you can give the living partner the value of give his family the value of the company, and they don't have to be, is your wife gonna come down here and take over for you? None of that. It's an automatic buyout. It can go 3 ways, it can go 17 ways. You know, however many partners there are in the business, it's a good way to just, we don't want to have any new people coming up, showing up trying to do the job. We'll just pay your family out for the value of the company using these insurance policies. And if we don't get there, we get returned the premium and it goes back into the company. So that's why that might be used. Now, here's the interesting two features to think about. Convertibility and renewability. So you have an 18-year-old son and you get him a $500,000 term policy because it costs somewhere around $50. When that son turns 32, and he's like, Dad, should I do more with my insurance? Like, yes, sir, son, you should get you a more permanent long-term policy. The convertibility allows you to take that value of the $500,000 term and convert it at $500,000 to a cash value policy, which will be permanent. Once you're given that value or that premium, and it will be priced at age 32, it will be really expensive, but you don't have to undergo medical. So from age, raise your hand if there's been some changes between your 18-year-old and your 30-year-old body. So that's why, you don't have to go back to the doctor. You can trade it over. And because they know it's expensive, you may not go 500 term to $500,000 cash value. You could drop it. You could go from $500,000 in coverage to $250 or whatever is most affordable, but it will be permanent. And sometimes there could be the case where something has happened that makes that 30-year-old would be normally uninsurable. Certain embolisms, certain conditions develop, but when you get that policy at an early age, guess what? They have to convert it no matter what their condition is. And they convert it, you just have to pay that new premium at their age, and they are covered. That's why I will implore you, get people under 25, get them to get their insurance early. Help them if you need to, but encourage them to set that aside and take care of that. And that goes into renewability as well. Renewability basically says, I got a 5-year policy, it's about to expire. They have to renew it. Now, you got it when you were 20, you turn 26, they're going to price it at 26, but they have to renew it. Now, again, there's a situation, they say you got a 20-year policy when you're 20, you turn 40, a whole bunch of things have happened to your life. Your health has changed. You still can get coverage because you're under that 20-year policy. And before that policy ends, you go and just get a renewal of the same term policy or you can use the convertibility feature to go to a cash value policy. And like I said, if there are any questions, the moderator, Brother Blue, will let me know, and I'll try to answer them as I go, or we can answer them at the end.
All right.
Whole life. Whole life. Whole life is a little different. A lot of the features are the same that you have for term policies, but whole life is the essential permanent coverage. I found over time that whole life is just a little pricey for most American families. There are other options that we'll discuss that are a little more affordable. So people would say, like, why would somebody have whole life? Well, at one time, that's pretty much all you didn't have a choice. You got whole life, and there wasn't nothing else. But what I've learned that people of substantial means, they will use whole life in a way to pass on a lot of wealth. And they pay a whole life policy off either in a couple of years, meaning they make all the payments in the first 5 years, or they make the payments in the beginning in the first month. There are people out here that actually could be 70 years old, and they will put a $5 million policy on themselves. And yes, it will cost them probably $4.7 million to get that policy, but depending on what the tax situation is, it's better for them to make their grandchild or the person the beneficiary of that policy instead of giving them $5 million. It could be gift taxes, estate taxes, all kind of things that are taken in consideration. But distributions from all life insurance policies are turned over tax free.
All right, Brother Hires, I did have a question that popped up before you go to the next one.
Mm-hmm.
The question was, with convertibility, is that really important? If they can reprice it, then they can just raise the price to make you not want to renew it, or are they missing something?
Well, they're gonna price it by age, but not by health. Because the idea is that when you got it at 25 years old, you had a certain health and weight. But a lot of time that it really benefits most the person who has come out, and maybe they've in 15 years down the line of a 20-year policy, you may have had a heart attack. Mm-hmm. They may be 100 pounds overweight, diabetic. It's really hard to get insurance. But once you're in, at least you can stay.
So is there a cap on what they can raise it to per age? Or
no, it's just look, because see, they won't know unless you tell them, but they won't know that you have had a heart attack because they're not going to look at your medical history. That makes sense?
It does.
So they're going to look at the 18-year-old you, or the original coverage, and they're just going to go back and adjust that for age.
Got it.
Whereas if you go in there and you didn't have a policy, you got the same issues, you're going to get what they call rated, that's when they increase your risk rating, whether you're a smoker, whether you're obese, whether you have contracted some things, asthmatic. Like I said, some conditions you're just not insurable.
Okay.
I guarantee you, if you have really high blood pressure and you're diabetic, you can't get insurance. Not very affordable. I don't care what they say on the commercial. But now some of these companies, and just to be honest, the organization I'm with, they really deal with high-rated companies. There are a multitude of insurance companies out there that do a whole bunch of different things. But the companies that I work for or work with, partner with, they just, I can tell you their risk ratings are kind of standard. So that's why it's best to get people insured, early as possible, in my opinion. Okay. In whole life policies, you begin to build a cash value tax-free. Now, how does that work? Let's say your premium is $250. The question is, how much of that goes into the cash value account? To be honest with you, it could be somewhere between 10 to 17, 20% going into the cash value account every month. And that in a whole life policy, The company takes that money and they invest in treasury bonds. Very safe. They're not trying to, run it up on Wall Street. They make very safe investments. And I think that's the lure as to why they cost so much, because I guess they're saying we know we're going to be here down the line. Now, that's not true for all whole life insurance companies. Someone sold something to my mother and my auntie, and they gave all of us our money back. I paid for one of my semesters at Tuskegee with it, but they gave all of us our money back because that company was going out a certain type of business, and the entire business was being sold. But they make very safe investments or decisions with the money that they get from you, and then they put a little bit back into the cash value account. Now, some whole life companies pay either dividends of stock or cash. If you ever see like Mutual of Omaha, a mutual company, they pay you dividends in cash. We were with MetLife at one time. They were a mutual company, and then they became a stock insurance company, meaning they were traded openly on the Dow Jones and on Wall Street. And they began to pay my mother shares of dividends dividends by shares periodically. By the time she passed, we had about 50 shares that was split between my brother and I. So that's another thing that whole life companies would do. Now, see, they don't take your cash value. Like I said, they don't take the cash value in your policy and put it anywhere. It just sits there and they credit your account. It's like some decisions are made over here with the money, the profits they have, or the revenues they generate, and then they credit your account with these dividends or with these cash deposits into your personal account. Withdrawals versus loans. Here's the tax implication. If you withdraw money from your cash value insurance policy, you're going to pay taxes on it. And you say, well, I thought you said we can get money out. You have to take a loan. And here's the trick. Inside of a whole life policy, most of them that I've seen, they're at least going to charge you between 5 to 7%. So really, whole life policies, they don't like you taking money out. They just don't like it. And you make some policies, you have to pay it back. Most whole life policies you do, but they really don't want you taking your money away in a whole life policy. And that's why I think it's really to be used by people of a certain means, to be honest. They like for you to basically leave it there, and you use your policy when you pass away to help out your beneficiaries. But thank goodness somebody came up with the universal life policy. There are different types. I really love a policy called Index Universal Life Policy, but I'll just explain the universal life concept. It's supposed to be a mixture between permanent cash value policies and term. The only thing term about a universal life policy is it's just not as expensive as whole life. There's permanent coverage, but they say you can do flexible premiums. And sometimes that premium is calculated every month. But let me tell you this. Flexible premiums are a possibility, but don't ever plan on paying a flexible premium into a universal life policy. Some universal life policies, a lot of them, they'll tell you, we have a guarantee of 30 years. That's cool if you're 60, not cool if you're 35. There's a possibility with a universal life policy, even though it has a flexible premium and all these things, that you turn 30 years later, they say, well, money ran out. You're like, how did it run out? Hey, it ran out. Now that's just it's just a bad deal. But the index universal life policies that I sell, I can tell you, hey, you got a flexible premium here. If you miss a payment, you catch up. This is true. This is true for all policies. It takes a long time for a policy to lapse. The government has done a pretty good job to say, give them about a year. And if they catch up all their payments, we'll put the policy back in place, or we'll keep it in place. But an index universal life policy, when I give you a premium, if you say, Freddie, I can do $500 a month, 500 a month? Are you sure? Would it be better to do 400 a month or 300? Because I don't want you to get to a point where you can't pay 600 a month and then it becomes uncomfortable and then things get real shaky with your policy down the line. I have what's called a target premium and I have what's called it's called a minimum premium. We're never going to pay that minimum. Just by them saying it's a minimum, it ain't going to work out 30, 40, 20, 30 years from now. It's just not going to be there. You won't be able to find me, but trust me, that policy won't be there either. So when I give somebody an amount, I'm going to give you an amount that works, that you think works in your mind. I don't care if it's 200, if it's 175, it is what it is. I don't want these things blowing up on you at the wrong time in life. Okay. Yeah, the premiums are less than whole life. You have a cash value accounts, multiple saving options. When the money goes into a cash value account for a universal life policy, what they do, some would call it staking. They may pick a mutual fund or a financial market index, international index, a Hang Seng, a Euro Stocks 5,000 market, or some other market to say, hey, they're up 8%. You're going to get a deposit. You're going to get paid 8% into your account based on what you have. You could get 10%. You could get 6%. But with the index universal life, the reason it works so well and the reason they don't falter, most index universal life inside of what they're going to pay you every year works the same way. Hey, the Dow Jones average went up 8%. We're going to give you a participation rate, which is going to pay you 9% or 10%. That's great. Oh, what happens if the Dow Jones Industrial Average falls 13%? They're going to put a floor there at 0. They have a ceiling as well. They may not pay you more than 12 to 15% in some of these policies. But when these averages or these indexes, when they go below and they lose, like we lost in August, when the market goes down, most of them will guarantee you 0.25 on the positive side, or there are some that do -1, -2, but they're different kinds of policies. Then they usually have a higher ceiling when they do that. It may go up to 20%, but that's the greatest thing ever. You know, when you ever look at the impact of losses on your money, you know, if you lose half of your money in an investment, just for instance, you know, if you lose half of your money, you know, what do you have to do to get all of that money back? You have to have a 100% increase. Even though you lost 50% of your money literally has to double. And just so you know, that's just not easy to do in the market. So when you look at indexes where you're never going to see a negative, it causes your money to grow naturally faster. I mean, that's a lot. Always call me to sit down and kind of talk about the details of it. But trust me, it works. Of course, you have your withdrawals versus your loan. And what did I say? Withdrawals, you pay tax. Loans, you do not pay tax. And matter of fact, 3 of the companies that I work with, Transamerica, Nationwide, there's another, the cash value that you've built up, if you take a loan within the first 10 years of the policy, there's a 2% interest rate. And that's to discourage you from taking money out of the policy, just to be honest. After 10 years, it's 0%. So as you build up money in the account, especially as you get down the road, 25 years from now, you take your money out, it doesn't have to be paid back. And the Index Universal Life was actually created, it was either in 78 or 82. And the reason I know that is because this country had the opportunity to give us these instead of 401ks, which started in either 78 and 82. They chose to go with the 401ks for some reason, but the wealthy took over. They just amassed crazy wealth inside of Index Universal Life. You had to be an accredited investor to even get one. And that didn't change until the IRS got involved, put rules in place, and then they let everybody else get involved around 92. But I didn't know anything about it until about 10 years ago. But I wish the country would have chosen to go with an index universal life strategy than the 401k. But, the people with money make more money in the 401k. So what am I thinking? Variable life products. Right off the top, I'll tell you, to sell a variable life product, you must have a Series 6 or 6.3 license. I don't have those. And the reason why, I'll explain. Permanent coverage, flexible premium, less than whole life, cash value accounts, but your money is placed out there on the stock market. I always see life insurance as kind of a safety net catch-all. I don't know why I want to intertwine that with the stock market. I've seen accounts like people like, yeah, we had $170,000 in our insurance policies 3 years ago. Now we have 25,000 because people don't check. Same through the 401k. Please watch a video on managing your 401k. Just don't sit there and let them send you that paper every month. Don't do it. Manage that thing. Anyway, with a variable life policy, you're mixing your life insurance with the stock market. I just choose not to offer that. I'm not even supposed to talk to you about it, other than telling you the definition of it. If you do have an issue with it, I work with people. They have all those licenses, and by the time they talk to you, you won't be getting another one of these policies. You'll be getting something even better, because there are a lot of great things out here available today instead of this. Again, it comes with withdrawals and loans. Loans, when needed. Withdrawals, tax, loans, no tax. Alternatives. So whether you're trying to add to your life insurance strategies, or you're just in a situation where you can't go get a standalone portable policy, what is out there? Of course, you have your employer. And I get one of the great questions when people are trying to load up on the index universal life. Now, Freddie, I'm paying like $23 for life insurance at work. Okay, what does it do for me? It gives me like 8 times my salary. Keep paying for that. You can't buy this out here. Anytime you see the word group, you're in a big old group of people. That means the risk is disseminated, so the values are really low. I get a lot of guys that come out of the military, great policies in the military, but as soon as you get out and they send you that bill on what it is now, that you are now back amongst the lazy, like myself, they got to do something else. It goes up because you're not part of the group anymore. You're a part of a different group. So if you don't have money to get a policy, the employer, group, whole or term life policy is better than nothing. Property and casualty add-ons. When I first started, I worked at Nationwide and State Farm. So it's nothing to say, Mr. Blue, I have you down here for your house insurance. We got you at $300 a month. Mr. Blue, would you be interested in adding some insurance coverage to that? We can get you $250,000 of coverage for maybe an additional $15 a month. And usually like, yeah. So that's an add-on. It's a real quick sale, but I don't know nothing about this man. I don't know nothing about it. Just that quick. Somebody say $15. Yeah, I'll take that. But raise your hand if you had the same life car insurance or house insurance your whole life. I have not. So it changes. It goes from place to place. But if you're in a situation where you don't have anything, you're like, but I need something, because I have a child or I'm with a family, whatever. This is a good place. You go to your insurance company. Even if you have a renter's policy, you can add it on there too. And maybe you don't get $250, maybe you get $50,000 or $10,000. Something is there. Banks, credit cards, you get those letters, all those mailers. They say, well, you already have $1,000. Well, but if you send us, if you let us take $15 out your account every month, you can have an additional $15,000 of life insurance coverage. Sounds silly to most of us, but you don't have what you call pulmonary embolism risk, do you? You're not a full-fledged, full-blown double-digit A1C diabetic. If you are, then you probably want to take advantage of some of these policies through your bank's credit cards. If you use a lot of these different strategies, you could very well have $600,000 or at least enough to cover final expenses if you stay on top of it and use them correctly. And it's better than nothing. Another way, mortgage, life, and disability policies. I'll start with disability policies because they're not offered as much now, or at all, I don't think. They were real popular or sold a lot in the 80s, 70s, and 90s. But then a lot of people, probably by the time I was getting my license, a lot of people have received messages that said, well, here go your premiums back because the cost of healthcare is going sky high. And we can't afford your disability policy. You know what we promised you 30 years ago? We were going to be able to pay you $2,000 a month for your medical injuries. Well, if we send you to a hospital with $2,000, you're going to be sleeping outside. So here go your money back. We're done dealing. Thank you for your time. So they're not that policy. I mean, they're not that popular, but a way that will help you with life insurance is that, let's say something happened before you needed a disability policy and you passed away, the money that was there would be passed on to the family, the beneficiaries or the beneficiary that was identified. I always say family because most of my clients will say family, but beneficiary could be other people as well. Mortgage life.
I do have another question for you, Brother Hires.
Mm-hmm.
Can you discuss the pros and cons of using life insurance as an annuity? I'm sorry, annuity.
I am going to discuss annuities as the last thing on the bottom of this.
Okay. All right. Perfect.
Because that's another method.
Okay.
Good question. I'll mix it in here because it's a little different. I know it's like pros. I said you said the pros and cons of.
Yep, using life insurance as an annuity.
Okay, I understand the question, but I may have to turn some things around to make it make sense.
All right.
But I will address that.
Okay.
Mortgage life. If you don't have any other way of paying off the house for your family, and maybe you can't go out and get extra insurance, I don't like mortgage life because you're already paying home insurance. Most houses that catch on fire, they will replace most of the value of the house, if not all of it. Mortgage life says that the owner of the home dies, we're going to pay off the mortgage. But when they price it on your $375,000 home, they price it at $375,000. Some companies leave it at that price, even though you only owe $100,000 on your mortgage. So I would say instead of paying mortgage life, I would encourage you maybe to go get just a regular life insurance policy that covers the length of the 30-year mortgage. But when you sit at the closing table and they say, well, your mortgage and interest is going to be $1,800, your taxes and insurance is additional $600, you're like, okay, yeah, that's a lot. And they say, hey, but we can add you a mortgage life policy and that will pay for your mortgage. Will pay for your mortgage in case of your death. Well, how much is that? That's $440. I mean, $40 a month. And you're like, because you got, you sit at a closing table, you got that weight of that mortgage sitting on you at $375,000. You're like, man, I wouldn't want to leave my spouse or my family or my kids with this. Yeah, I'll go ahead and get it. And that's right when they ask you, right? As soon as you sign, that's when do you want? And a lot of people get it, but I don't like it. But what I would tell you, maybe hold on to it from $375, but once you cross $250, you may want to go get some other type of insurance. Final expense policies, just so people know how they work, they call modified whole life insurance policies. And how they work is this. You don't get the $30,000 within the first 2 years of holding on to these policies. So what happens is they usually don't pay above $30,000, maybe go a little higher now, but they, usually there for final expenses. There are companies that will let you plan out your entire final ceremony, complete with carriage, drawing horses, and all this stuff. But within the first 2 years, what typically happens on most of these policies, like Colonial Penn, if you have to pay $100 a month, but you would pass away in the 18th month, or the covered person would pass away in the 18th month, they will return the $1,800 plus 7 to 10% to the beneficiary. You only get the face amount, whether it's $5,000 to $50,000. You only get that after the 24th month is completed. And I will tell you, encourage again, if you know of someone who you think may need a final expense policy, because there's nothing there and there's no big wad of money to handle their final expenses, it is best to secure that now because of that 2-year waiting period. I hate to be morbid, but it is what it is. We're talking about life insurance. So as early as you can, you want to put that in place. Just so you know, strangely enough, it's always been strange to me for the last 10 years, Gerber Baby Foods Company has one of the more affordable straight final expense policies that is offered in the industry. Go figure. Now, retirement annuities. The annuities that I've set up, how when you're working at a company, you worked there 7 to 10 years, and they say you leave, go to another company, and they say, oh, you got $30,000 that you can transfer into your next 401k or your next 403. Well, a lot of times people will take that money and they will put it into a retirement annuity as a lump sum. And they run these 6 to 7, 8, 9-year programs where they tell you how they're going to pay off and make deposits in there, maybe 6% this year, 8% this year, whatever. And you keep running that. And then when you get to age 59 and a half, you begin to take that retirement income out. Usually the money goes in there. Tax-free, and as long as you wait till 59, it comes out tax-free. Now, the question that came up was what's the benefits of using an annuity as a term life? Was that if I understood it correctly?
Yeah, and Brother Cook, you could come off mute if you want to kind of express that a little more to clear it up. But it said, can you discuss the pros and cons of using life insurance as an annuity?
Oh, I see. When you set up most people that have a life insurance policy, they may say, give me the lump sum, I'll make my own decisions. In some cases, you can go in through a trust sometimes, and sometimes through the actual insurance company, and determine how you want that payout. With an annuity in particular, there are 4 different ways. I can't remember all of them, but there are 4 different ways in which you can get an annuity payout, especially depending on what happens to the person that actually owns the annuity. The reason I see it as a life insurance situation is that, let's say you don't make it to 59 and a half, and you pass away at the age of like 52, the money that's there goes to your beneficiary, thus making it a life insurance policy. Sometimes people will come out and they'll say, well, I would like to get a straight payments till death. You're going to pay me $600 a month till the day I die. And after that person dies, no matter how much money left in the account, it's over. That's done with. The person loses that money. A lot of people are smarter than that. Now they would take maybe not $600 a month. They'll take $450, knowing that if there's anything left over, it goes to into the beneficiary or the family that's left behind. If I understand correctly, a brother that asked about the term life, it is possible to use a life insurance payout in a couple different ways. If you send it into a trust for children or even adult children, you could say, hey, I don't care how much it is, 10,000, or if it's 100,000, you may just put it in those children's name or the beneficiary's name. They don't have to be children. They have to have you have to have an insurable interest, they call it, and use it as somebody in the family, sister, brother, not sure about aunties. But anyway, you may put it in a trust for them, and when they turn, you put it into an annuity, And if they take it out of the annuity, there's a penalty. There's severe penalties for taking the money out, 10%, just like a 401k. But also, if they leave it in there from age 30 to 59, then it's going to benefit them. It's depending on what the immediate need is. If there's a normal, level-headed person that's the beneficiary who knows how to who has proper financial education and knows how to make their own money decisions, could be a bad idea. May not make it to 59 and a half. May have an immediate need right now for a business idea or financial ruin that comes up before 59 and a half. But if you know the person is financially catastrophic in everything they do, then you may say, well, what can I do to keep this money from this person until maybe they mature in the next 2 or 3 decades? Yeah, you throw it over there, but it doesn't mean I'm not a trust attorney. You have to consult them. I don't know if they can't take the money out and just pay the penalty on it. So that's why I'm not sure about that part. I'll just be honest. Definitely contact me and I can put some people on it who know exactly what the rules are there. But yeah, retirement annuities, anytime you have that rollover from the 401k, you can put it right into annuities and you can basically make your own retirement decision instead of clumping it in with your the next organization, especially if you monitor it and you find out, like many people do, I don't like the 401ks anyway. When you get a chance to take the money out, sometimes people pay their bills off. That's a mistake. That's a mistake because that's money for your retirement. You're not going to be able to may not be able to amass that type of wealth, $30,000 in 7 years like you already have done. So use it to its fullest extent by taking control of it, even starting your own IRA, managing your own IRA, or like I said, you can come the annuity route. If you don't want to make a lot of big decisions, you just want to see normal growth over time. That's what annuity does for you. But I do say that these are alternatives to life insurance, because if you have an annuity and it's $150,000 and something happens to you before you start making your withdrawals, or if something happens to you while you're making your withdrawals, that is money that can be passed on to beneficiaries.
All right. Thank you for that, Brother Hires. I do have another one for you.
Mm-hmm.
So it says, Brother Hires, where are most African Americans in the life assurance realm? Where do you think the average Black man or Black person should be, and why?
Woo. So we're going to say this person signed on late. No, it depends on your personal situation. As I said, it's 56% of us have some type of coverage. I don't know if it's portable or if it's not portable, but when you're thinking about generational wealth or transitional wealth, it's where you want to be. I have walked into homes with people, kids everywhere. And the first thing I'm thinking, like, oh yeah, I know we're gonna get about $100,000, for every child. They were like, oh no, don't worry about them. It's like, well, if something happened, you want to send them to college. They're like, that's on them. But I don't know if they got a college fund that backs with answer these questions. But it really is depending on where you want to be. They may know their children are going to private school and they should be able to get a scholarship, academic scholarship. What we got here, the Hope Scholarship, and they're not worried about them ever paying for college. But it's just, when you say, well, I get to decide where African Americans, where we should be, that's a tough one. I wish we were just all out of debt. That would mean so much, even more than the life insurance sometimes. But when it comes to life insurance, you should be able to take care of your own family expenses, and perhaps just think about, we use a measurement, okay? We use a measurement when we sit down and we say, okay, what are going to be your family expenses? And we say, like, how many years are your children in the house with you? What kind of debt is there? We just use this whole little simple equation to come up with the amount of money that you should have. And usually when you do the count that money, it comes to the millions. Okay. Like if you're a family of 4 or 5, when you are family or female with a family, and you start counting it all up, how much of your income does your 2-year-old need for the next 16 or 20 years to get them through college? So you add that in, and you add in what's the value of the house. And by the time you start adding it all up, it would appear that you need millions and millions of dollars if you were to fall over the next day and go to the great beyond. So it's really hard without sitting down with everybody's, getting a case by case basis. Life insurance is I think is one of the most, other than a good restaurant, when you talk about word of mouth, to find a trusted professional, because I can advertise all day. The companies I work with, they advertise around you all the time, but just because there's a green line on the ground, that don't mean you're going to jump on it. You have to kind of talk to people and see who they're comfortable with, so they will have that real conversation. Because let me tell you, for most of the people on this call, it is $1 million number, and a lot of people don't want to pay for $1 million of insurance. So well, can't pay for it and afford to eat a few times a day, but it can be pretty pricey. Like, I just would like to see everybody with some type of coverage based on where they are. Like I said, these 18-year-old kids, if you can afford it, don't buy them no more Christmas gifts. Go get them a $500,000 term policy. Even though they may not know much about it, or if you help them pay for it, they have to get it, but you can pay for it. It doesn't cost as much as it would by the time they turn 30. And then with proper counseling, they can make decisions once they're in their 30s. But right now, I would love to see that 56% go up to 80% of us having coverage, but it seems like it's going down. And that's unfortunate.
Absolutely. Absolutely. Well, that's all the questions I had in the chat so far. So I don't know if you have another slide after this one. Continue moving.
Well, I just want to let everybody know that, the life insurance is all about these crazy guys out here. And as we went to the Atlanta Food Festival or whatever, this is a picture from a long time ago. And, this is what it's all about for me. It may be about something else for other people, but we want to make sure that the goals and dreams that they have on the other side of those funky looking glasses, that they can be held intact just in case something happens to either one of us. And especially if we keep eating all that Duke mayonnaise down there on the ground, we want to make sure that everybody's taken care of. And that is the end of my presentation. If you have any more questions, just let me know. And I want to thank you all for your time. Here's my email address and the phone number. You can contact me anytime, leave a message. I'll get back to you, or send me a text. Be glad to talk to you.
All right. All right. Well, thank you so very much, Brother Hires. Now, if anyone have any questions at this time, you could come off mute and ask the questions, and we'll go from there.
Brother Hires, you mentioned something earlier that I would like for you to reemphasize, and that has to do with the concept of locking in your life insurance while you're healthy. I had a personal experience where I had a great insurance agent who mentioned it to me when I was in my 20s. And so I started by paying $26 a month for a $500,000 term policy. And then later on, I did find out that I had high blood pressure and diabetes. And so by the time I was 30, in my 30s, he started talking to me about converting it to a permanent policy, because if I hadn't gotten that term policy, then the rates would have been a whole lot higher if I would have even been able to get life insurance at all. And so now, being a father of 3 and a husband, it's very important to me that I have some type of coverage that I will leave to my family. And of course, I work and I do have insurance through my job as well, but that was a portable policy. And, even, if I got fired tomorrow, my life insurance would go away through my job, but I would still have, that policy to leave to my family and help my wife take care of things if I was gone. So, that's very, very important to me. I'm so proud of myself for making that decision, with the
Oh,
right type of
bravo.
guidance. And I just want to make sure everybody hears that and feels it, because it hits me in the heart every time I hear somebody talking, making reference to that.
Yeah, I've come across so many people that are that are not insurable. Um, I think the youngest person was like 26. Um, as I want to reiterate what Brother McCain is saying, is that when you have these 18-year-old people in your lives, before they go out and get into the next phone or turn on a service or doing these other things, have that serious conversation. Make them, if you can, twist their arm. And it may not be 500,000, it could be $200,000 in coverage, because life comes at you fast. And diagnosis comes up and it changes everything. A lot of people don't even know, what does high blood pressure mean to the normal 20-some-year-old. What is diabetic diagnosis mean? And who's even thinking about that? But it's a hard conversation to have, but it's true. If I just think we get more people, because I say majority of 18, 19-year-old people, they don't have issues. And every once in a while I run into, there's a young lady out there's a client of mine, and she got it. She got it and she jumped on it at age 18. She has a policy that when she turns 55, there's supposed to be cash value of probably at least between $350,000 or $400,000 there, and she's going to increase that once she starts working. But that's because time value of money. The value comes from the time that you have. That's why you get people started as early as possible. That's everything. Well, they get into investments, buying land, and making mistakes, whatever. The earlier they start, the better. But I do know that most people, no matter what their background is, a life insurance strategy, when you start it as early as possible, it's just, or people that have grandchildren, if you start their policy as early as possible, the better it's going to be. If you start them before 18, they're called juvenile policies, and the rules are a little different. You can't start them. They have to be converted. That conversion may cause the price to go up. That's why I said they get them as adults. They fill them out. Maybe you fund them. You tell them, I don't have no more gas money, no more Daytona money for you, but you get them started. You put the money where it really matters. And then once a little maturity kicks in around 27, 30, hopefully they'll get it. Hopefully they'll get it. But thank you, Brother McCain, for that testimony.
All right. Are there any other questions? Any other questions? So I did have one that was text to me. This person said they have retired and been retired for 5 years. They had their company life insurance. Is it too late for them to invest in a life insurance now, being healthy and a senior citizen?
Call me tomorrow. There's a company called North American Company. That's why I say your individual situation matters. We have to have a discussion. It may not all be done, but if you're a member of AARP, I am. I made my wife one. Yeah, that's right, baby. Anyway, if you remember AARP, there's an insurance company out of the blue called North American Company. I was like, I ain't never heard of no North American company. They do wonderful things for people over age 50. I wouldn't go as far. I don't want to lie. It's like they take people that are 60 and they treat them like they're 30 within reason. But we can start there. And like I said, final expense policies are always a catch-all if that doesn't work out. So if you take my information down, I took my presentation down. But if you wanted to contact me and have a conversation about that, I am definitely open for that. Because that's on an individual basis. The history matters. And a lot of people are kind of shocked because Cobra said you got to give people their benefits. Well, Cobra don't never tell you how much you're going to pay. I wish they would tell people that, but they just don't. If you've ever separated from a company, they say, "Oh, and I have separated and I have been separated from companies," and they see this Cobra thing. You're like, "Okay, woo, thank goodness." and that health insurance comes in there, and it's like it was $80 a pay period. Now these people want $700. Like, are you crazy? They're like, well, you're not down with the team no more, so you can get coverage, but do you really want to get coverage? So, but yeah, contact me, give me a call tomorrow, and I definitely will be more than happy to do what I can do, see what I can do.
All right, perfect, perfect. Are there any other questions? All right.
I guess if I may, Andre.
Yes.
Brother, I just want to also say that thank you, because people do what they have to do, and I'm not knocking anybody, but it hurts my heart when I hear of, someone passing away and, their children, and I've had this happen in my family, but, their children are left without any way of burying them. And so you see these GoFundMes, and it's just not the way that I hope things happen for my family. And so, what you're doing is kind of, I call it spreading the gospel, so that, again, so that Black families don't have to exist in that condition. And again, if people have to do it, I'm not knocking you for doing what you have to do in order to bury your loved one with respect, but it would be much better if we had it planned out, taken care of, and we weren't creating a burden for our next generation. And then, another thing is the life insurance. I think of it when you think about the 18-year-olds that you talked about, I think about setting them up with a life insurance policy as my way of reaching down into that second generation, because that's who will benefit from that 18-year-old passing away and leaving a policy to someone with their kids, Exactly. And so that's my way of reaching out and touching my second generation away, my grandkids, like you say. So you're doing a great job, brother. I appreciate what you do every day, and I hope you're very successful with it. And I appreciate you sharing the information with us today.
Thank you, Brother McKay.
Absolutely.
I thought I would get through. When I first started doing this presentation and putting it together, I wanted to put something about the GoFundMe in there, but there was no easy way to add that to the conversation. It seemed kind of cold, because, like I said, people have to do what they have to do, and I'm glad I've just never addressed that publicly. But it is kind of sad.
We have another question. We have a hand raised from Ms. Harris. We're not able to hear you. You're not on mute, but.
I think your husband has the mute button.
It wasn't me. It was not me. What is wrong with your headset? You wore it out today?
All right. Did you want to write it in the chat possibly? Let's see. Brother Holloway said, great job, Brother Harris. Very informative.
Thank you, Brother Nate. Brother Holloway, I haven't seen you talk to you in a long time. Good to hear from you.
Ms. Harris is still not working. Okay.
Hey, since my name got thrown out there, Fred, I'm gonna keep this to myself, but I just feel compelled to ask, and I don't know if anyone will benefit from it, but I will ask. And this is something I talked with Brother McCain with some time ago. In terms of long-term care, because I know that the industry has been changing. Can you speak on long-term care policies versus the long-term care life insurance hybrids that are out there, and the pros and cons of those? Can you speak on that?
Well, yeah, long-term care, like I was saying earlier, they don't really offer the the disability policies like they used to. Long-term care is usually inside of a policy, and at the time when you would probably need it most, which is probably after age 50, you want to attach it to a permanent policy. And something that I have on my notes here that I didn't mention, or maybe I did, 3 or 4 Americans over age 65 will need some form of long-term care, in their life, whether that's at home with a professional or with a family, or in an assisted living facility. My grandfather was very popular at his assisted living facility. He had someone cooking him dinner every day. And I said, Granddaddy, you're not too old to get cut. So, and or even in a nursing home care, when you can't take care of yourself. So it is it's kind of important maybe to think about a type of policy that will provide those type of that type of features down the line. We don't have to take out of whatever wealth you've built up for the next generation. You don't have to just consume it all, sell your house, do whatever the rules of Medicare are just to go into a nursing home. If you can afford it, and if, like I said, some people may not have the child that can take a person in, depending on what the issues are. My father currently has dementia, and he's a veteran, so the VA is taking care of him down in Tampa, Florida. But everybody don't have that background that he has. So what if the parent was, worked out here in the public and there's not a lot of funds there? They have to come home with family, but they may not be able to take care of them. So that person has to basically liquidate everything. Everything. They may have been planning on giving all the grandkids $10,000 a piece, but under the Medicare rules and the look back rules, I don't know if anybody's familiar with that. In order to qualify for Medicare in Alabama and Georgia, there's a look back rule. So let's say you start getting stuff out of mama and them name. Let's get stuff out of papa names so we can get them in. No, they're going to look back 5 whole years to see what they own. And when they look back 5 years and they find out y'all had the house in Buckhead, Medicaid want their money, or that person won't be allowed into Medicaid. That's why Florida was one of the popular retirement states. Florida's look back rule is I think it's 1 year. Arizona, all the popular retirement states, that's what made them popular. The look back rule is it's a lot easier we can take care of for 1 year. But sadly enough, we have a frat brother. He lives in one state. He's from another state where his mother was, but because of the look back rule, they put the father in Florida. They held on as long as they could, got him a resident of Florida, made him a resident of Florida. But this man, he was going through Parkinson's. He needed long-term care in a nursing facility, but he had a business. He had a mechanic shop, house, land. They had to wait a year to turn him over to Florida Medicaid, because if they had done it in Alabama, they would have lost everything. Unfortunately, that meant weekend visits. And while the family was there to be with him when he passed away, he was really living in that city by himself. So long-term care is it's very important, and it may not be for everybody. Only thing I could tell somebody to do outside of that is to have great children, treat them well, try to do your best. But long-term care inside of a index universal life, like I said, you can get it inside of you can have some money available to you in a term policy, but it's probably going to run out at age 70. So you're looking at a permanent option. And here again is why I say, start as early as possible. And you have all these options available to you as you move forward, and you gain understanding. An 18-year-old probably won't think about long-term care unless they've experienced the issues with the older parent or grandparent or something. But yeah, long-term care is critical. Thank you for the question there, Brother Holloway.
Definitely. Thanks for the response.
All right. And we had another comment in chat that says, great and useful information. Thank you.
Thank you.
Yeah. All right. Are there any other questions? All right. If not, I hope everyone that took this Brother Hires information down. As you can see, it's FreddieHires@gmail.com. Telephone number is 678-870-4001. and you could call them, text them anytime, and he'd be able to help you with the personalization of your life insurance, or even answer some questions that you may possibly have. So,
Yep.
Ms. Hires, did you put your hand up again?
That was by accident, but can you
Oh,
all
okay.
hear me now?
We can hear you now.
Oh, okay, cool.
Yeah.
I can share my comment if you have time. But,
Yeah.
I was gonna tag along to the comment about the what is it when people raise money online? What's it called?
GoFundMe.
GoFundMes,
Mhm.
and things of that nature. And I do agree with what one of the attendees said. You know, people have to do what they have to do, but we can get in front of that by talking to our people about their legacy. You know, would you, you know, that's a better way, I think, than to talk about, you know, death and burial. But, you know, really ask them, you know, what type of legacy are you interested in leaving? And, people are people, and we all have choices and decisions to make. So someone very well could tell you, you know, I don't care about legacy. When I'm gone, I'm gone. Let those people figure it out. And that's certainly their decision. But I think um, the more common response is you will find out that people do care about their legacy, and it's not their hope or their intention to leave their family members with a mess to clean up, or, you know, struggling to just make final arrangements. Most people don't intend to do that. That's why it's important to have these conversations early on. And you know, if you all have family members that you are having or need to have this conversation with, I wanted to share my story. My father passed away in December. He was a very um, proud man. You know, he managed his affairs. He didn't really talk a whole lot about things, but you know, his land and his property, his animals, that was his space. That was like his heaven on earth, right? And when my sisters and my brothers and I had to make final arrangements for him, the he left us a beautiful gift in that his affairs were in order. And you know, my mother is well taken care of as a widow. She has raised her six children. You know, part of it is treating your children right, so that when their turn comes to care for you, you know, there is no hesitation. That is very important. I will share with you all and invite you all to share. You know, my mother has options, and that's what we remind her of when she gets down, when she, you know, is going through the natural phases of grief, and we have to talk with her about, you know, why, you know, she's important to us and why we need her in our lives and thriving. And it's part of that legacy that was so important to my father. And I've had the opportunity to see that, you know, come to kind of like full circle. As a child growing up, I couldn't stand, you know, being in my parents' house because they wouldn't let me do whatever I wanted to do. You know, as a teenager, I couldn't stand being there because they wouldn't let me do what I wanted to do. As an adult, I said, you know, I'm leaving here at 18. I never went back. And they said, don't come back. You know, go do what you need to do because we've raised you to do those things. And, you know, but, you know, now I do find myself doing what I need to do, and that's going back home to take care of my mother and, you know, the property that he left. But I'm telling you all, and you all can share this with others, legacy is where that conversation should go, because most people in their heart do not intend to leave their families in a point where they can't even have dignified services for them, you know, in a timely manner. And, you know, we have heard all of the horror stories, and they are true. But if you can tap into someone and talk with them about legacy, you can help change their life, or you can, you know, you can change your life as well.
That's
Thank
awesome.
you. Yeah.
Yeah, thanks for sharing that story too, Ms. Hires. All right. Did you have any closing remarks, Brother Hires?
No, if you have any questions, you want to talk about if you want to review an old policy or talk about a new situation or discuss your future legacy, just let me know. I'm available. Call at any time. If I don't answer, please leave a message or send a text. I will definitely contact you. I want to thank you all again for your time, your patience, and I hope my Alabama accent wasn't too difficult for you guys. But I thank you all for being here, ladies and gentlemen. I wish you good night.
All right. So I'd like to thank everyone for tuning in. Thank you for Brother Hires and Sorrel Hires on everything that you shared with us today. Appreciate all the brothers that's on the call, all the sorors, and all of our friends and family that's part of supporters of the Kappa Alpha Sigma chapter. So once again, thank you all for tuning in, and everyone have a great night.
Great job, Brother Blue.
Thank you, sir. Thank you.